Okay, guys, so this is 2 a.m. We want to look at what Powell is saying. So please note that this is not the usual FOMC meetings, okay? Because on the FOMC calendar, we don't really have any official meeting. But sometime once in a while, right, he will come up and speak. And even though it is outside of the usual FOMC meeting, when he does speak, right, it can move the market. So it might move the market. It is not like 100% confirmed move, but it might move the market. We don't really know. But it is good to watch also. So for those who are wondering, right, since I'm nowadays more involved in US market, right, my bedtime is like 3 a.m. So this is normal for me. so I'm not sure how many of you stay up specifically for this when it is your bedtime okay. So normally I'm up at this hour anyway, but since I am up, right, and we have something on, I know, okay, why not, if any one of you still up, you can come and join so at least we can watch Mr. Powell and his tools together. And just to give you some background also, for those who are new, but I don't think there should be anyone new here. I don't okay, maybe one or two new names, but the rest are the usual folks. Thank you for your support for coming to this session. So this is not a live trade, okay? We don't do live trade. I personally think live trade is dumb. We don't do daily trading. We don't day trade. But I mean, I do some YOLO trade once in a while, but that's for fun, okay? That's for itchy finger trade. It is not part of our legit trade. So let's go through some background, okay? We have Jerome Powell, Mr. Powell, the federal chairman, speaking in 22 minutes time. So this timing is not always accurate, because this is just him speaking. This is not like we are waiting for a Federal Reserve hike number. Last time when we met at 2 a.m., right, we are actually waiting for a number to come in, which is the Federal Reserve rate hike. But for now, right, we don't really have any numbers coming in. So sometimes he can start the speech first, or who knows what's going on also. Okay, so one thing I want to share is that if you are here for the past few meetings, right, I share a lot of times already, okay? So during the April, this period, right, you will realize that there wasn't any official Federal Reserve meeting also, but you will notice that the market suddenly dived down on 21st of April, this calendar here, okay? 21st of April, it does seems like the market is going for a bull and then find some support, and then a lot of bulls get kinda trapped here. I got so many people, so many friends, so many people from other forums start buying here left and right. Like, oh, the recession is over, the bear run is over, or the ABC wave, whatever okay. So but eventually something happened on 21st, and then the market just died down. So what happened on 21st was that during one of the meeting, 21st April, Jerome Powell said that 50 basis point hike is possible for May. But of course, now we already know that it is a 50 basis point hike. Okay, so this is the past already. And because of that, right, the market immediately dived down. In fact, it dived down to the minute. If you go to 15-minute chart, right? If you go to right at the 15-minute chart, this little point here, this right here, this one. If you notice, right, it is somewhere around the time where he start to speak, and then after that, it just dive all the way down. But of course, the macro condition for the market is already bad. Meaning, right, whether Jerome Powell speaking or not speaking, right, eventually it will dive anyway. So if it doesn't dive in May, right, most likely it's gonna hang around. Then if it doesn't dive in April, right, most likely price gonna hang around sideways. Then in May, when they hike by 50 basis point, right, it will dive anyway. So it is a sooner or later thing. It is just that during 21st of May, there was a catalyst. To trigger the dive. But regardless, it will dive sooner or later. Okay. So now we are here again to see whether if he will say anything that can cause some major market movement, some volatility in the market. So for those who are new here, right? In fact, most of our group already got our position. We managed to get Apple last week. We managed to enter Apple last week. How's Apple doing? Apple doing not bad, not bad. Wow, recover quite a lot already. We actually got Apple here. So for those who have Apple, right? Let me tell you, you are in a very safe position, okay? You are in an extremely safe position. You are in green, you are in profit, paper profit, unrealized profit. That's good. Unrealized profit is good. Why? Because you can afford to be greedy and hold through this kind of situation. Because let's say if you just hold through, right, and market start to drop back down, right, at most you exit at break even, there's no risk for you. But if let's say during this period market go up higher, right, then wow, you are in a very nice position already. But let's say you are someone who like thinking want to enter now, right, it's a bit risky because later something happen, it come down, right, you are gonna lose money. Okay, so if you want profit, right, it is always a question of can you risk or not? Because for example, if let's say you are an Apple holder and you decide to run now, because you are in profit, you want to keep your profit, you want to run first before anything happen, right? But later if something causes the market to rally, you are going to miss the profit. So what you are risking is you are currently risking your unrealized profit, okay? So you want more profit, right? You must risk something. There is no profit without taking any risk, okay? So you are either risking unrealized profit or you are risking actual losses. So, but because if you adjust your mindset a bit and you kind of think of it as a way that, okay, since I am already in unrealized profit, right, I can risk this unrealized profit for more profit, since at the end of the day, I'm not really losing any realized profit. Okay, so hopefully you get what I mean. And that's how I usually hold and slingshot my position also. If you are aware of the Amazon trade, right? If you are aware of my Amazon short also, I shorted here, and then when price was here, right? Or sorry, I shorted here, I shorted somewhere here, and when price was here, I decided to go for double down. I double down some more because my original position is already in a profit, so I can do some risky movement. Okay, if you straight away went with a double down movement right at the top, right, then it is slightly risky. Or if you double down when you are in a loss, for example, you enter here and then price go down, you double down here, then that one a bit risky, very, very risky. Okay. So normally I like to push my luck when I am in the unrealized profit state. So before we go to the actual I think is he speaking yet? No, he haven't speaking yet. So we have Home Depot result that came out. It kind of went down a lot, but currently it's recovering also. But it's okay. This one you just leave it alone. It's not hitting the stop loss. Okay, we already went through this on Saturday webinar. I already told you guys that if you are holding any shorts, don't worry, just stick to your trade plan, just let it be, because most of the home builders, home furnishing companies are selling on good result. In fact, almost, for example, Builder First Source had a very good result here, gap up, but end up sell down. Then we also have Pool Corporation, very good result, gap up, went up, but eventually sell down and price go down also. Okay, so this is already a trend. And Apple already at 2%, very nice, very big, should be in quite some profit. And Tesla also was quite okay. Tesla, I gave out a freebie trade yesterday. So for those who, I don't know, if you are the daredevil that went in like yesterday somewhere here, then you are okay. But if you went in, or if you decide to skip the trade, right, then I mean, is probably a good decision also, since the candle was a bit bearish. But maybe if you want to join in today, also fine. Up to you, okay? Up to you. Now we are very near the speech time already, so I'm not gonna give you last minute trade, okay? Unfortunately, Walmart, the result came out today and it was a horrendous result. And Walmart result being this bad, right? It is very alarming. It is alarming in a midterm, long-term perspective, because it does shows that inflation is really bad and Walmart is taking a hit. Okay, so we will talk about Walmart. earnings on our usual Saturday webinar. Like, it's too much. It's too much to go through right now. So a few things. Hopefully you guys got your wine. I got my wine. I got my wine here. My wine bottle is there. I even got potato chips to for this whole thing. That's what full-time trader do lah. Okay, we are awake at 2-3 a.m. in the morning with alcohol and snacks. Yes, correct. Market look very green. Market look very green. And a few things. Sometime yesterday, we have a news that says US Federal Board members say 75 basis rate hike is on the table. So suddenly 75 BP is on the table again. Last time Powell say not on the table, now on the table. Then like they like the Federal Reserve member like not in agreement like that. Some on the table, some not on the table. And at the same time, we also have Goldman Sachs. This was actually on 14th of May, quite a while back. I think it was Saturday. Okay. So it was on Saturday. So Goldman Sachs slashed the year-end target for S&P to 4,300. So this is actually the third time that S&P year-end target got cut. Initially, it was targeted at 5,100. That was from last year. Then sometime during January, it was cut to 4,008. Then sometime during March, it was cut to 4,005. Now it is cut again to 4,003. So you might be wondering how come Saturday got a very bad news, and then yesterday got another bad news again, 75 basis point, but the market isn't. The market is actually responding quite positively to all this bad news. And in fact, that is one signal that I can sort of confidently say we are at a temporary bottom. The keyword is temporary. It's not gonna rally up very high, okay? So don't go and YOLO all your long position. It is only a temporary, okay? So because the market is no longer responding to all these bad news, right? I think there is a temporary bottom for now. So we see how high it can go up, okay? And then we just grab whatever we can get, and then eventually it's gonna U-turn. I think it will U-turn somewhere around this area here. But I mean, that is a guess lah. We don't know lah. If it U-turn somewhere here also, we will run lah, okay? So the moment we see like a big gap down, we will kind of like run already. But it is good to see green candles out, okay? And because this is a bear market dead cat bounce, right? You are not going to see like a very like super duper aggressive rally like that, because there are definitely be seller coming in. Every time it goes up, seller coming in. So you're gonna see a little bit of choppy rebound instead. Unless later Powell say something that like just go and push the entire market up. Okay. So follow according to our Saturday plan, okay? Don't abandon your short position. Don't go and abandon your short position. The reason why we are taking this dead cat bounce is to make up for the lost time that our short positions are facing. Okay, so there are a few places that you can actually watch the Federal Reserve live. So normally you can go to their actual Facebook. So I'm actually subscribed to their Federal Reserve. So whenever there's a live, right, they will show. Or you can just watch from Bloomberg also. I usually watch from Bloomberg because they will, after you watch already, right, they will just let you know the so-called the important points that Jerome Powell say lah. Because if you don't really have experience, this is your first time listening to Federal Reserve members speak, right? Maybe you might not understand which area to focus on, what is the important points, what are all the nonsense, what are all the opinions and all the so-called the full of shit stuff that they are saying. Like for example, every time Jerome Powell say inflation is transitionary, right? Those are the kind of nonsense that you shouldn't be focusing on. But what you want to focus on is, okay, you want to raise by 75 basis point or what? Do you want to raise by 50 basis points? So you need to know how to read between the lines, okay? it is truly testing your listening comprehension. Okay, so I'm gonna just open Bloomberg audio, and if you have any question, right, you can just ask and then I'll just try to answer lah.
Heat homes in the winter without the propane off that line. So while the U.S. is facing an energy crisis, why in the world would the U.S. government not come on side with Canada and Alberta and just tell the governor of Michigan, work with Enbridge on the new safe subterranean pipeline to replace the one that's been safely operating for 60 years? Well, we'll watch to see where that conversation goes. Before we let you go, Premier Kenney, as Alberta's economy is rebounding right now, your leadership is on the line. We're awaiting the results tomorrow of the leadership review for your United Conservative Party. What do you think happens? Do you think you will win that? Well, I'm optimistic. I've been all around Alberta the last couple of months since we've been able to drop all the COVID restrictions, and I'm getting overwhelming expressions of support because, you know, we turned the corner. COVID was divisive for our party, like many communities around the world. But the worst of that, we believe, is behind us. Alberta is leading Canada in economic and job growth. Our government has kept 90% of our election commitments with a year to go, a year of economic growth. We're growing the economy, creating jobs, getting pipelines done like Line 3 and TMX, and building a stronger province. I think the majority of Alberta Conservatives want to move forward together, not go into the ditch of division. And so I'm optimistic about the outcome tomorrow.
Alberta Premier Jason Kenney, we thank you as always for your time joining us from Washington. Coming up, blocking payment. The U.S. is set to shut down Russia's ability to pay U.S. bondholders. More on what the move could mean for Moscow's odds of a default next. This is Bloomberg.
You will shed light on dark matter. You will make aging optional. You will turn 5G up to 11. Because when you subscribe to Bloomberg,
Let's go and look at what the Wall Street Bets folks are doing. Since we are waiting anyway, I think we can find some entertainment there lah. These are like 1 hour ago. Sometimes it's very clear that these guys are trading while they are working. Is this what it feels like to be inside a bear trap? J. Powell launched this rally into orbit. Time to short? Yes, yes. So in fact, there are actually a lot of bears here also. J. Powell eat butt. NVDA refused to stray significantly from key 180 level in either direction, probably looking to the J. Powell speech for direction. I don't really think so. I think NVDA is waiting for the result. NVDA result haven't out yet. But AMD result was very strong though. AMD result was very strong. NVDA result coming out. So, and in fact, NVDA and AMD is the two counter that I am looking to bottom pick when the market truly recover. Not this big cap bounce. When it really recover back into bullish mode, I will go for this lah. I mean, don't really need to bottom pick when market recover and AMD is somewhere here already, or NVDA is like somewhere around here. We can buy the next breakout also. We don't need to catch the bottom. Okay, don't need to be always hero try to catch the bottom. There's no point. And in fact, AMD is like really showing very strong price action. Is able to retake 100, is able to retake the 100, which is a very good sign. So what I will probably see or might anticipate going forward, right? It might go up a bit together with this relief rally. Then eventually it will come down. And when it come down, right, hopefully it will create a lower high here lah. And then if we create a lower high, we will catch the next leg up. Okay, So that's the plan for AMD. Similarly, if NVDA earnings shows very strong, it will create a similar action also lah. So we want to catch the second leg. We don't want to go and like blindly catch this bottom. You try to catch this small rally, then later it chung back down. You are dead also lah. So there's no point. What's going on? US or they are blocking Russian debt payment. J-Powell is about to mount us. Sometimes the language they use 10 minutes until bear funeral. Zero chance this dumps below 400 SPY. So it seems like everyone is looking at 4,000 as the support level 4,000 as the support level, which is, I believe, probably true. Maybe this was the fake breakdown, if you want to call it a fake breakdown. SPY up quite substantially though. SPY up quite substantially. When does Shrek speak? 10 minutes till bulls are F. Bulls and bear, you can listen to J-Powell here. Oh, okay, that's good. That's good. Okay, haven't started yet. There's a countdown. There's a countdown. Okay, so good. We can see from here. Oh, it's from Wall Street Journal. So nice. Okay, we got a countdown already. So are we gonna sit here pretending Elon is not massively manipulating Twitter share price? Yeah, I truly believe he is manipulating lah. Wall Street Journal is streaming J-Powell live here. I don't know, it will get me into trouble, but here we go. Last chance to get out. From here, you'll be seeing only blood. So like the bulls and the bears here are really very polar, one very extreme. I can tell you, if you are not good with your emotional management, right? If you are the kind that whatever you read, you believe, and then you come here and read all this, you won't be able to get a good trade. Like one moment you will see everyone is bear, and then the other moment everyone is bull. Then once in a while you have this kind of nonsense troll . I am nervous. In fact, last time I always trade last time, like I used to trade forex last time also, and I always trade non-farm payroll with a very big position in my newbie days lah. And whenever that 1 minute before the non-farm payroll number come out, right, I'm always like, hey, I'm very nervous, because either that time I was very young, my trading account is like $1,000 on a MT4 account with like 100 times leverage. So usually that one trade, right, I'm either going to lose like $500-600 or I'm gonna win $500-600. A lot of nonsense leh. Usually there are a lot more trade calls that they are doing, although their trade call not really it's not really for following you shouldn't be following their trade calls here but at least it gives you some awareness to some of the things that are running for that day, right? And then you can go and take a look also. Biden speaking too? No. Who else is buying DOCS call? Yeah, so who's buying DOCS call? Peloton got 2 times order book for 750 million long. Oh, they got a lifeline. How's Peloton doing? It probably went up a lot. That's why they are talking about it. Piton, where's Piton? I don't have Piton here. Let's add Piton. It's red, but it's red. Holy crap, Walmart is down 11. It's like at the day bottom, it's not really giving any chance. Fiscal 2023 profit lowered. Ouch, no wonder dropped so much. The retail giant now expect earnings per share for 2023 to decline about 1% and excluding divestiture to be flat from previous year. Wow. We are behind for the year. We are also just 1 quarter in the year with time and option in front of us. Okay. It's good lah. It's good that they are upfront and lowering some expectation. But look at this price drop, man. Like we are back to 2021. Is he speaking? See, he's late. What? J-Pop is dead. What's wrong? What's wrong with these people? This is true though. I think 75 point high also cannot do anything to inflation. Twitter. Let's take a look at Twitter. What's Twitter doing now? Oh, it's actually up 3%. But look at that. That is ridiculous. Oh my God. Elon Musk actually buy somewhere around here, I believe. He bought somewhere around here. Now it's back. It's back to that level already. And in fact, I think he actually didn't follow one of the SEC rules where he was late in disclosing his position, and then it sort of allowed him to buy more at a cheaper price. Costco also down. I think it was probably hit by Walmart's earning also lah. Like when NVDA is down, like the day where AMD result came out, right, and it went up, gap up a lot. NVDA price also gap up a lot. Rivian has been going up a lot since the earnings. So this is the reason why I don't like to short things that already gone down very low. Because if you try to short there, right, actually, even though this movement is very small, it's not small, it's actually 20%. It's actually 20%. Anything that's still red. CrowdStrike is red. Cloudflare is red. Coinbase rebounded quite a bit. Apple still at 20% plus. Still haven't stayed yet. Tesla still maintaining. I wonder if, let's say, the Twitter deal doesn't go through, right? Tesla will rally some more or not. I think the reason why Tesla is dropping is. Oh, he's speaking.
Thank you, Nick. It's a pleasure to meet you. And I want to welcome our audience watching along on WSJ.com, Twitter, and YouTube.
So, Chair Powell, let's get started. 2 years ago, you acted very quickly and decisively. You did things that Fed chairs straight up have not done, given the emergency of the pandemic. Now, I hear a lot today, especially from our readers. They look at the economy, they look at how high inflation is,
Haven't
and they
speak
look at
yet,
the state of
Bradley.
monetary policy, and they say the Fed is not reacting with the same urgency. What do you say to people who say that you are not treating high inflation today like an emergency?
Well, I guess I would start by saying this, Nick, that we know that this is a time for us to be tightly focused on the path ahead and on getting inflation back down to 2%. We know how people are suffering from high inflation. And we have both the tools and the resolve to get inflation back down.
His tools again.
And no one should doubt our resolve in doing that. And I think if you look at how quickly we've moved in the last few months, really, then you'll see that financial conditions have tightened quite a bit. What we need to see is inflation coming down in a clear and convincing way, and we're going to keep pushing until we see that.
So to get into some of those tactics, the Fed raised interest rates at its last meeting.
You can see S&P performance here, okay? Currently at 1.62. So I won't switch back and forth.
Your next two meetings. Why are you being so specific? Doesn't that limit your options?
Well, I didn't say, so we make the decisions at the meetings. What I said was a couple of things. First, I said that we decided to raise the federal funds rate, range for the federal funds rate by 50 basis points at the last meeting. We also said that we thought ongoing rate increases would be appropriate. And during the course of the meeting, it became clear that there was very broad support on the committee for having on the table the idea of doing additional rate increases of that magnitude at each of the next two meetings. And that's what I said. And that's short of a prediction or a statement that forward guidance that we're actually going to do this. But I would say if the economy performs about as we expect, then that's something that'll be on the table. And honestly, it's so things are so uncertain in the economy right now. It's very difficult to think about trying to give guidance out into the future. We don't know the path of the economy. There are many global events going on that can affect that are really not under our control as well.
So if the base case is to do a half point for the next two meetings, why not just do a percentage point at your next meeting? Rip the Band-Aid off.
Well, as you know, inflation works through, monetary policy works through expectations. So markets are pricing in a series of rate hikes, a significant series of future rate hikes, amounting to already having done that. So we like to work through expectations, and I'm not blessing any particular day's readings, but it's been good to see financial markets reacting in advance based on the way we're speaking about the economy. And the consequence, as I mentioned, is that financial conditions overall have tightened significantly. I think that, broadly across financial conditions, you're seeing that, and that's what we need. What we need is to see really growth moving down from the very high levels that we saw last year, moving down to a level that's still positive, but that will give the supply side a chance to catch up and a chance for inflation to come down as we
What's going on? He didn't even say anything.
Back together.
What's going on?
A couple of years ago, you talked about moving slowly when you're in a dark room, when the lights go out. Obviously,
Okay. So the guy asked, since he is going to raise 50 basis points several sessions, right? Why not? Might as well just raise it by 1%, just 1%, rip the Band-Aid off and be done with it. And Jerome Powell didn't really want to do that. So I think because of that, now it's coming back down. Yeah, I mean this kind of movement is normal, okay? So don't expect too much.
Central bank practice in recent decades, we're moving about as fast as we've moved in several decades. But I guess the way I would say it is this: what we need to see is clear and convincing evidence that inflation pressures are abating and inflation is coming down. And if we don't see that, then we'll have to consider moving more aggressively. If we do see that, then we can consider moving to a slower pace. And it's going to be a judgment call that we make going forward as we carefully monitor incoming data, the evolving outlook, how are financial conditions changing, how are they affecting the economy, and that's how I think about it.
So back in 2016, you were a governor of the Fed, and in late 2018, you were chair of the Fed. There was a significant tightening in financial conditions. There were some global growth shocks. Global growth was slowing, and the Fed pulled back from its plans to raise rates. Maybe it's
You can see on the daily candle is it's zero, like not much lah. Okay, not much. So don't bother too much by that small movement. Okay, so don't panic run. Oops.
the pace of rate increases right now.
You know, the underlying strength of the U.S. economy is really good right now. The U.S. economy is strong. The labor market is extremely strong. Growth this year has been marked down, but is still at very healthy levels. So you saw today's retail sales number. The economy is strong. Consumer balance sheets are healthy. Businesses are healthy. The banks are well capitalized. So this is a strong economy. And we think it's well positioned to withstand less accommodative monetary policy, tighter monetary policy. We do monitor global events, and global events have been very important drivers of economic conditions lately. The war in Ukraine is something that has upset the global commodity picture, while also threatening the global order more broadly. And the rolling shutdowns in China are still going on, and those are having an effect on global supply chains, of course. So we watch those things, and we watch how they affect the U.S. economy. The effects are very uncertain. They probably weigh on growth, downward on growth, and probably push inflation up at the margin. But even through all that, we see the U.S. economy continuing to show real strength and be well positioned to handle the policy changes that we're making.
Chair Powell, a number of your former colleagues, Richard Clarida, who was vice chair until this past January, Bill Dudley, the former New York Fed president, have said recently that they think that the Fed is going to have to raise its short-term policy rate to 3.5%, maybe 4%, maybe higher. How are you thinking about the destination right now for how high you might have to raise interest rates?
So, as a policymaker, the way I'm thinking about it is that right now we're raising rates expeditiously to what we've been saying, to a more normal level, which is something that we'll reach maybe in the fourth quarter. But it's not a stopping point. It's not a looking around point. We don't know with any confidence where neutral is. We don't know where tight is. We just don't, and particularly in this environment of higher inflation and very strong growth and a really tight labor market. So what we're going to be looking at, meeting by meeting, data reading by data reading, is what's happening with financial conditions and what's happening with the economy. Really, with what effects are changes in policy having on the economy? Are we starting to see what we need to see, which is a really clear and convincing evidence that inflation is coming down? That's what we really need to see. So we'll be watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't. And honestly, we will go until we feel like we're at a place where we can.
The reason why it's like that is like you can see now Jerome Powell, right, and the Federal Reserve, right, they literally have no plan. They always want to wait and see, which is very different from how past Federal Reserve do things. Because past Federal Reserve, right, they usually have a plan. They will outright say, okay, we are doing this amount of hike for this year, and that gives the market some clarity, okay. That gives the market some proper planning, proper clarity to work with. But in this case, right, Jerome Powell is always like not sure, don't know what, don't know this, don't know that. One day says 50, one day say 75, one day say no more 50. He's very blur. He seems like very blur. You have no plan like that. And when Federal Reserve don't really give a proper plan, right, the market don't really like it. So they will always sell off. The market will always expect the worst and they start selling off. But of course, in the grand scheme of things, right, we are still up 56 points for the day. Okay, so this is just normal liquidity movement. So you should not be making trade decision based on this movement. Okay, you already have your position, just let it be, just let the speech happen, and after that, we see how it goes.
In our policy, and since then you've seen really quite significant tightening in financial conditions. I don't know that financial conditions have tightened more quickly than this in a very long time, and but that's what happened. And I've said for the last 2.5 months, I've been saying that if you look back in hindsight, give yourself 20/20 hindsight, then yes, it probably would have been better to have raised rates earlier. We were looking at some weak employment reports. We were looking at inflation reports that were coming down. When that stopped, and when the data started pointing toward a stronger economy with higher inflationary pressures, higher wage pressures, we didn't hesitate. From that point, we really moved. I would say almost expeditiously. Since then, we have moved, and you see where we are 6 months later since that happened. You now have the 10 years up, 140 basis points. The 2 years up almost 200 basis points, and the 2-year Treasury is a pretty good measure of policy expectations. So quite a lot of tightening, and appropriately so. Inflation is way too high, and we need to bring it down. And we're going to use our tools to do that.
Obviously, the pandemic has made economic forecasting more difficult than it's been in a long time, and I wouldn't presume to think that it's easy. But looking at demand last year, the fiscal stimulus that was approved by the administration and Congress last March, it was far larger than what your own economists of the Fed were anticipating. Did that end up putting the Fed behind the curve in terms of you just didn't judge demand properly because of the much larger stimulus that was approved?
So it's really not our role in economic policy within the government to reach judgments on economic actions taken by Congress or by the administration. There are other parts of the government that do that exact thing. That's really us. So I guess I would say that there was a lot of stimulus put behind the U.S. economy. That was both monetary policy and that was fiscal policy. But still, you can't get the kind of inflation that we've gotten out of that much demand. That was a lot of support for demand. You can't get the kind of inflation we had without these supply bottlenecks that we've had, and that includes the supply chain problems that we've had and the shortages. If you look at automobiles, that's a great case. Ordinarily, car makers would have just made more cars. There was tremendous demand for cars, but for really idiosyncratic set of reasons, there weren't enough semiconductors, so there aren't cars, and so you have tremendous vehicle inflation. That's just one example. Same thing, we didn't see. We had a real hit to labor force participation. We didn't see that come, and so really these supply side factors, you have to add them in to any kind of economic model to get the kind of inflation that we have. We clearly had very strong demand, and we knew that. What we didn't know and anticipate was how large the supply side effects would be and how persistent they were. And we now know that in hindsight, and we see how sticky they are. And so, as I mentioned, we're not setting policy on the expectation that we get relief on the supply side until we actually do.
All right, so that was 2021. Then comes along 3 months ago, the war in Ukraine, which has obviously been enormously disruptive to millions of people in Eastern Europe, but also has had a profound effect on energy markets, commodity markets, and we also have new lockdowns in China. How have those events changed the difficulty of what it is that you are trying to do?
Well, I mean, clearly they've raised the degree of difficulty more importantly, for the people around the world who are looking to have a continued expansion in the economy, but also for us from the standpoint of policy. So, the war in Ukraine is pushing up commodity prices for both food and energy. And the thing we don't really know how long that's going to last now. It might have thought at the beginning, and we don't make those kind of judgments that it wouldn't be long lasting. Now it looks like it may be, so that may be a persistent effect. Same thing with the rolling shutdowns in China. They won't last forever, but they'll last for some time, and they're having an effect too. And what they're doing is they're preventing any healing of supply chain problems. So that's going to make it harder for inflation to come down. And so really they've added to the degree of difficulty to what was already a challenging project.
So we heard here before lunch from Barry Biffle, the CEO of Frontier Airlines. He says he's raising prices because of fuel costs, and there's a pilot shortage. And now those are things outside of your control. But you said just now that the Fed can no longer set policy on the hope or expectation that supply chains will give you a lot of help here. So what does that mean for Fed policy? If these things are out of your control in the supply chain, or if energy markets don't improve anytime soon, what is the implication of that for policy?
Well, it doesn't have much of an implication in the near term because we clearly have a job to do on demand. So there is an imbalance in the economy broadly between demand and supply. And so we can't really affect supply. The things that are really supply side issues, our policies don't work on those. But we have a job to do on demand. And I would, for example, point to the labor market where there's more demand for workers than there are people available to work by a substantial margin. And so that means that wages are moving up, which is a great thing, but they're moving up at a pace that is not consistent with 2% inflation. So there's a pathway for us to use our tools to try to moderate demand, still to a positive level, but not at the high level that it was at, for example, last year, and try to get demand and supply back into alignment in the labor market or close to it, so that there'll still be positive wage increases and healthy wage increases, but they'll be at a level that is more consistent with 2% inflation. Wages are a very important determiner of inflation over the longer term. So that's just an example of what our job is, and we think we can do that job. In the meantime, of course, everyone is looking for the supply side to heal more. We don't see much evidence of that yet, but I mean, I still think in the longer run, that has to be coming. There will be semiconductors and other things that are in short supply right now.
A lot of people, though, are skeptical that you can get inflation down to your 2% goal without a recession. What do you know that they don't?
I don't know anything that they don't. I mean, I would say there's no disagreement here, really. It is going to be a challenging task, and it's been made more challenging in the last couple of months because of global events. So it's challenging because unemployment is very low already, and because inflation is very high. And so, but I will just say there are pathways. Clearly there are pathways for us to be able to moderate demand, get demand and supply back in alignment, and get inflation back down, while also having a strong labor market. Doesn't mean that the unemployment rate needs to remain 3.6%, which is very, very low, historically low.
Basically, what we just said.
50-year low. You'd still have quite a strong labor market if unemployment were to move up a few ticks. So I would say there are a number of plausible paths to having a soft, or as I've said, soft-ish landing. And our job isn't to handicap the odds; it is to try to achieve that. The last thing I'll say, though, is that achieving price stability, restoring price stability is an unconditional need. It's something we have to do because really the economy doesn't work for workers or for businesses or for anybody without price stability. So it's the bedrock of the economy, really. And so that's something we need to do if we want to have the kind of labor market that we all want to have, which is one where there are tight labor market conditions and wages are moving up and people are changing jobs and opportunity is growing and all of that, but inflation is not high and eating up people's paychecks.
So Chair Powell, I heard you refer to a softish landing, and I want to ask, what's the difference between a soft landing and a softish landing? Because if the
Good question. He says softish landing.
start to wonder what he's talking about.
Well, so you fly around, sometimes the landing is just perfect, right? And sometimes it's just a little bumpy, and so it's still a good landing. You don't even notice it, right? So, but in this, what does it mean in this setting? So I guess I would say this: we have to get inflation down to 2%. We've got to restore, our definition of price stability, and we will do that. It will be challenging to do that we have to slow growth to do that. That's the idea, is that growth has to move down. That's what has to happen for inflation to come down. We don't have precision tools. We can't say let's dial it into this exact level. We raise interest rates, that affects financial conditions, and financial conditions affect the economy. So there are a couple of steps there, and it is not in any way a surgically precision set of tools. So I would say there could, as I mentioned, there could be some pain involved to restoring price stability, but we think we can maintain a strong labor market, defined as a labor market where unemployment is low and wages are moving up. It may not be the perfect labor market, but it will be a strong labor market.
So I'll move on from this subject, but I want to ask if there's a historical example that you could point to for what you're trying to achieve. Some people talk about the late 1990s, but even then the unemployment rate continued to drift lower after the Fed raised interest rates. So is this something that we have any recent historical experience with, what you're trying to do here?
Well, so you can look back to 1960. There have been 11 tightening cycles. And in none of those cycles do they look anything like the current cycle. We've never, I won't say never, but I'm not aware of a time.
True. That's true.
2 job openings for every unemployed person. And it's just an extraordinary, it's a once in a century pandemic, followed by historically large fiscal and monetary policy support, followed by a war in the middle of Europe between 2 commodity makers, followed by a partial shutdown of China, a very large economy. That's the manufacturing center, one of the manufacturing centers of the world. So can you look in the history book and find that? No, you can't. And so I just think we're in a world of firsts. So I wouldn't say just because it's never happened before, it's impossible. I wouldn't say that. I would say that there are plausible paths, and that this will be challenging, but we'll do our best to achieve it. And in any case, we will achieve price stability.
So what are you looking to see, either in inflation or in financial conditions, that tells you that things are moving in your direction? Because it feels like there's a chance here that inflation does come down in the second half of the year, even though it'll still be above your target. But there's also a chance that the labor market tightens even more. And I wonder how you would, I know it's hard to respond to a hypothetical, but that doesn't seem like a crazy hypothetical to be considering right now. A situation where you do get improvement on inflation, but you do continue to overshoot an estimate of what might be considered a more stable employment situation.
Well, the main thing is to get inflation down. We all read, of course, everyone reads the inflation report.
Yeah, very good questions.
And looks for details that look positive and that kind of thing. But truthfully, this is not a time for tremendously nuanced readings of inflation. We need to see inflation coming down in a convincing way. That's what we need to see. And until we see that, we're gonna keep going. We're not gonna assume that we've made it until we see that. And we're not seeing that right now. There are some promising signs. You can point to them. There are some signs that are not promising. But really, that's what we're looking to see. So with the policy rate where it is, you don't need to. What we need to do is push ahead with rate increases, and make the evaluation that I mentioned earlier. Is this the right level? Should we slow down? Should we speed up? I think that's what we'll be doing as we see incoming data, and make a judgment about where are we? Have we gotten as far as we need to get? And until we do, we'll keep going.
Now, a number of people have suggested to me that the one thing that might slow you down, or at least make this much more difficult, would be some kind of market cataclysm. And I wonder, in part, if that's why you're trying to be more transparent, not erratic, making sudden moves on your policy moves. But my question there is, where's your level of concern that financial stability and controlling inflation by raising interest rates maybe a lot might be fundamentally incompatible in that raising rates causes financial disruption, but doesn't actually bring inflation under control? Where is your level of concern around that situation?
I don't see that happening. I mean, we monitor a very broad range of financial conditions, and we're doing that now. We'll keep doing that. And, you know, they're different cycles look different. Sometimes the tightening takes place in one market, sometimes in another, sometimes in credit spreads, sometimes in all of them. So we're watching them all, you know, as a group. And, you know, of course, their volatility has been up a little bit, and that has some effect on liquidity in some markets. But nonetheless, the markets are orderly, they're functioning. I think they're processing the way we're thinking, the way that the FOMC is thinking about policy pretty well. And I think that the idea, again, is to have financial conditions tighten to the point where growth will moderate and still be positive, but moderate to the point where supply and demand can get back in alignment, and where we can get inflation back down to 2%. And I see that broadly working pretty well right now. Obviously, there are some volatile days in volatile markets, but so far, I see us as getting through this fairly well.
So this is the Future of Everything Festival, and in the time we have left, I want to look ahead at some of the issues on the horizon for the economy. Labor shortage. I wonder if you see that as something that might be a more persistent rather than just a cyclical feature in our economy. I mean, if you look at net immigration since 2017, because of policy reasons or the pandemic, it's been basically flat. Are labor shortages here to stay? And what would the implications of that?
Guys, I'm going washroom for a while. Okay, I'll be back in a while. Help me listen.
And imbalance between supply and demand in the labor market, and you put your finger on it. It's part of its population. There's the labor force. There's the labor force participation rate. But if the population is growing more slowly, there are going to be fewer workers, and that's a big part of the story. Really, in recent years, is immigration has been quite low. These are not tools or things that the Fed has, or places where we seek to guide policy. But if you have a slower growing labor market, you're going to have a smaller economy, and you could be in a situation where these wage pressures remain longer. Of course, we'd love to see labor force participation come up, but I do think I think that's a risk in the medium term, but it's really one for other policymakers to look after.
And related to that, economists have this concept called the natural rate of unemployment. The idea that when the economy is finally balanced, there's a level of unemployment that corresponds with stable inflation. And I went back and looked. When you joined the Board of Governors almost exactly 10 years ago, the participants once a quarter project where they think these things are. And so in 2012, you and most of your colleagues thought that level was between 5 and 6%. Now you and your colleagues have been writing down that it's somewhere between 3.5 and the low 4% area. But how much weight do you put on the prospect that the natural rate of unemployment, perhaps temporarily, perhaps not, has actually shifted higher and might be closer to where you and your colleagues thought it was 10 years ago?
Well, no, I think that may well be right. I think there was a tremendous amount of turbulence in the labor market, and so in theory, the sort of matching function that is the labor market could be disrupted. People are changing jobs at all-time record rates, and there's just a lot going on. People are reevaluating their commitment to the labor force. So all of that points to a higher natural rate of unemployment. But the other thing that's clear, though, is that the effective natural rate can change pretty significantly over the course of an expansion, particularly a long expansion like the last one, where you finally had 3.5% unemployment and no sign of either wage or price inflation. But you had a couple of years there where unemployment was well below 4%, and you didn't see inflation. So that suggests that as that longest expansion in recorded U.S. history, 10 years and 8 months, as that went on, what you saw was matching getting better and better and better and more efficient, and the natural rate coming down. Right now, it feels like the actual unemployment rate is not a perfect you have to think about where the unemployment, where the natural rate is compared to today's employment rate. And it does appear to me that it's probably well above 3.6%, but it should shift down as this highly unusual time in our economy and in our labor market goes on. It should, we should see that settling down, and we should see the natural rate declining, and that itself could reduce wage pressures and inflation pressures.
Well, all things equal then, I mean, would you, as the chairman of the Fed, feel more comfortable today if the unemployment rate were a little bit higher, somewhere in the 4s instead of in the 3s?
I'm never going to say that more people need to be out of work. I would love to see a labor market that's more in balance, and ideally that would start with the number of vacancies coming down. And that's one of the things that is vacancies and quits are at all-time highs, and that suggests a labor market that's out of balance, and there's more demand than there are workers. So I'd love to see people come back into the labor force, and we are seeing some of that. We'd like to see that continue, and we'd like to see the job vacancies level come down so that you're seeing supply and demand get back together. And the unemployment rate will shake out where it needs to be. It's as I mentioned, it's close to a 50-year low right now.
Moving from sort of the post-pandemic labor market to the supply chain and inventory management, it seems much more possible than it did a year ago that we're going through a big shift in how businesses manage the supply chain, and the forces of the last 25 years that really helped central banks keep inflation low, businesses pricing an efficient supply chain now you might want resilience. You might want to source goods from multiple suppliers, and that could embed higher costs. So what would be the implications for the Fed if we're going through some kind of regime shift where those forces that helped bring prices down over the last 3 decades are reversing now? So
I do think you've had sort of a perfect storm of disinflationary forces for the last quarter century, and that's globalization, amplified by technology. It's aging population, certainly in the Western democracies, and all of that has, and low productivity. That has all led to disinflation. And so some have been making the argument for years now that those forces were all going to flip. I don't think they would flip overnight, but I would say, certainly in the near term, there is a real possibility that globalization will go into reverse to some extent. And the trade-off would be those supply chains were very efficient, but they weren't very robust, and they broke down pretty badly in the pandemic. So I mean, to the extent you do that, you'd have more security in your supply chain, more stability perhaps, but it might not be quite as efficient as the amazing global supply chains that we had, which were very, very fast and flexible and all that. So I'm not sure what the overall, you could see higher inflationary pressures for a time, but at the same time, policy could respond to that. So I don't know that you see higher inflation.
Exactly like S&P.
So it's hard to say. Globalization obviously brought its costs and its benefits, and it benefited lots of parts of the world. And from our standpoint, we got a lot of products cheaper, but our manufacturing base in the West is vastly diminished. And you're right. It would be a very different world if we see that go into reverse or pause.
We're almost out of time. I'm going to try to sneak in one last question to you. You were confirmed last week to a new 4-year term with significant bipartisan support. Someone joked to me, you see that sort of support only to adjourn the Senate these days. You've been through a lot in your first 4 years as Fed chair, especially in the last 2. Is there anything you've learned in that time that might change your approach to this job in the next 4 years?
I think that there's an overwhelming need to get inflation under control. And that's what I'm thinking about. And that's what we're thinking about here at the Fed. In times when you're at 2% inflation and the economy is growing and unemployment's really low, you can have a more balanced thought about what you should be doing at work. I think we know what we need to be doing at work right now, which is to get inflation under control, and we'll use our tools to do that. That's my dominant thought about the future at the Fed. it's a great honor to be able to serve a second term, and of course I'll do my very best, to carry out our obligations under the dual mandate, and leave it there.
Well, Chair Powell, thank you so much for joining us this afternoon. It's an honor to have you with us. And thank you to our audience on WSJ.com.
Okay, guys. So you have, I'm not sure if this is your first time watching Jerome Powell live and watching the market. So very important, you should not be making trade based on this kind of movement. Okay, your trade should be made long ago. And this is what I will call the liquidity movement, where the direction is already set very long time ago. The smart money, whatever, the bull, the bear, whatever you want to call, they already know whatever direction they want to go. Okay, so it is just that sometimes they just use this kind of catalyst to churn the volume and create liquidity, because during this time, a lot of retailers suddenly buying long position here and then kinda catching out here, then all the bear go and short there, then kinda catch out here, all kinda slap left and right like that. So what is being creating here is volume, okay, the liquidity. So if the smart money is going up, right, they are whipping all the short seller to soak up their selling order. Or if the market have already decided to go down, right, then they are faking all the buyer to soak up all their buy orders. So wherever the market direction is, we don't know. But based on what we hope to happen with our recent trade, we do hope to see a so-called a relief rally lah. Okay, but in a bigger time frame, the market is still down. So we are not making trade decision. We are not making analysis based on this kind of movement. Okay. If we go to daily time frame, right, this is like almost the movement is non-existent now. Okay, and in fact, even on a minute time frame, right, you can see that like the market was very volatile here also. And can anyone remember what happened here? I'm sure no one remember what happened here. Even I can't remember what happened here. This was like 16 May. When was 16 May? It was like on Monday. What happened on Monday? Nothing. Absolutely nothing happened on Monday. Okay, so be very careful about this kind of thing. Okay, so let's just recap. Let's just recap. So the main thing that I can take away from what Jerome Powell is speaking is all not very good. If you read between the lines, right, he is basically saying if things look bad, right, the Federal Reserve is not gonna stop raking the hike. In the other word, screw the market. They are not gonna care about the market. They are gonna continue to do a rate hike lah. But I do agree with him in saying that the economic condition we are in right now, it is a first lah. It is the first that he know about. So we are in a very unfamiliar situation, uncharted waters, where he really cannot predict what's going to happen because we have never been in this situation before. We are hit with the COVID-19, and then there's a lot of stimulus coming in, and then suddenly this inflation that is suddenly rising up out of nowhere with all the supply chain, and then the Russia-Ukraine conflict coming. So I do agree with him that it's really hard to predict lah, and we can't blame him for saying he don't know lah. Okay, so I think that part can give him credit lah. But one thing I do not agree with that is the point where the inflation that he was mentioning, he didn't know the inflation will be this high, and the inflation is not coming from the demand side. The inflation is not just coming from all the stimulus, right? But it is also coming from the supply chain. So that part, I don't really agree that much. Yes, maybe supply chain might cause this kind of inflation, but the whole supply chain things, right? I believe it is slightly, I would say, overcredited lah. Okay, it's slightly overcredited. Yes, supply chain can cause inflation, but not to this extent. Not to the extent where we are at the 40 years high inflation. Okay, we are at the last time inflation was this high is 1982. I wasn't even born yet. So it is highly unlikely that supply side will contribute this much. So what I can say is that perhaps 90% is contributed by the demand side with all the stimulus being injected. There were oversupply of stimulus, and then the supply side caused by all this travel restriction, all this probably just 10%. I think by now, no matter what, the supply chain should be back to normal. But the reason why the so-called supply chain is still an issue is because we still have overwhelming demand. And I'm sure you all heard him say just now, the retail sales today were very good. It was beating expectation. The retail sales were 0.9%. The core retail sales was 0.6%, where the expected was like 0.4%. So in fact, the retail sales meet the expectation or beat the expectation. So economy is strong. But in the current market, right, economy strong is not a good thing, because economy strong means there's still a lot of inflation. The reason why retail sales so high is still because there's a lot of demand going on. There's still a lot of stimulus money that are running around. So if you inject the market with this amount of liquidity, this amount of stimulus, right, that money is going to stay within the current economy. It cannot suddenly vanish. The moment you inject the money, right, it's there forever. So they inject so much that even until now, right, when the GDP have already declined, we have a negative GDP growth, but all this money is still floating around, and the inflation is still going up. So when you see news saying things like economy strong, that's bad for the stock market, okay? Bad for the stock market, because it will mean that Jerome Powell is gonna like hike the rate until don't know where. Like if you see things like, oh, the job number very strong, that's not good news for the market, okay? That's bad news for the stock market, because job numbers strongly, they can just hike as much as they want, but they can still retain full employment. People still have jobs, so the economy is still strong. But maybe the market might not be so strong, okay? So that's another thing to take note about. But overall, the takeaway point is as long as the inflation remain high, right, or if he can see very clearly that inflation comes down, they are not going to stop with the rate hike, which is very bad news for the market, because he's essentially saying he's not gonna save the market to reduce the inflation. Because you are normally faced with these two choices when you do monetary tightening, fiscal tightening, selling of the treasury, all this, right, it is bad for the stock market, and he have to do all these things in order to bring down inflation. So it is always an either or thing, and when it comes to a decision, right, and if he cannot achieve his softish landing, that guy seriously asked what's the difference between soft and softish. That was like the most ridiculous thing ever. Yeah, but he will let the market go in order to solve inflation. So despite the fact that everything seems to be bad news, seems to be bad, we do have market that is currently responding very well. And why is it so? Why is it that the market is like kind of okay? Like, sure, it is because the market already know Jerome Powell cannot do shit. Jerome Powell is not able to provide a proper plan, proper timeline, because you have to also understand that he cannot suddenly raise the rate so high. If he suddenly raise the rate so high, right, and then when the inflation is already solved, then he raised the rate so high for nothing. It's gonna cause the market to crash for no reason when the inflation is already solved. So he cannot take extreme action, and he need to take like a step-by-step approach. So the market already knows that. The market already kind of like priced in that already. And in fact, when yesterday or Monday, when one of the Federal Reserve Board members says 75 basis point is now on the table again, right? The market doesn't care, because the market already like, okay, like they don't know what they are doing. They are like, whatever they say about how many hike they are not going to trust okay. So market kind of like price in all this thing already. So I believe you can see now is going up is going up. I think it should be able to. Oh wow, nice, show or not. So that's why you don't do any funny thing here. So market pricing all the bad news ready, it should go up until I don't know lah, until we hit some resistance and then we see how lah. Okay, so that's basically my view on this. So there's a lot of factors in play. Okay, it is not just you look at one factor and then say market up, market down. It's not like that. First, you need to look at like 10, 20 factors, and then you need to understand whether the market have priced in this ready or not. So the only way to see whether something has been priced in, right, is you wouldn't like this answer, but it's by experience. But one of the few clues that I can give you is when market no longer goes down due to bad news, right, it is quite a good sign that market already priced in all sorts of bad news lah. So any more bad news, it might not hit it so hard really. So of course, when you want to place a trade, right, you cannot just randomly bottom pick the moment you see bad news also lah. It requires a lot more skills than that lah. In fact, for those who are aware, right, for those who have been in our webinar, we were looking for a relief rally for quite some time already. We caught a relief rally here. And then somewhere here, I was looking for a relief rally. I was looking for one. And it was only until last week we sort of placed a position lah, because every time we try to look for a relief rally, market just sell down, and it was quite dangerous. And it was only last week we managed to sort of successfully manage to catch it, even though it wasn't like a 100% confirmed trade, right? We know the risk, we went for it, but and we were able to safely get our trade in lah. And of course, we were able to safely navigate through this meeting also, kind of like facing a little bit of resistance already. So before I end this session, right, let's just take a look at Wall Street bets. Like now, probably all the bull coming out and say, you bears are like, fuck lah, this lah, that lah, rug bull. What did the pump say? What did he say? Hey, crude oil tanking, bull thesis equal bullshit. Watch this play in reverse tomorrow. I just want market to jump off the cliff. Where are the bears that bulls are living? Fighting inflation is bullish, boys. LOL, mooning for no reason. Did I miss J Powell speaking already? What is the schedule? This kind of people is like really have no idea what's going on. Come on, Google, why are you lagging? Why the fuck are we mooning? Why are we mooning? We have no idea what they have no idea why are they mooning. Why is the price mooning? Let's look at Apple. Nice, 2.43%. Just suddenly showed up. Okay, hopefully Apple will be able to close intraday high lah. Okay, intraday high was here and it is going to go up. Hopefully it will be able to go up. Tesla doing very well also. Tesla recover very well also. Going 2%. Okay, guys. So your don't worry. If we are gonna TP, I will let you know. I will let you know before market open. Okay, so don't worry about your position. For now, I will say hold. We are in our long position are very healthy, very good. Okay, so we survive. Okay, so hopefully this gives you a little bit of experience on how to deal with news and noise movement and to stay calm. But number one rule: don't make trade decision during this kind of period. Your trade should be done long ago. Okay, or if you don't have any trade set up, don't FOMO into this. You FOMO into this, you bull also die, bear also die, whatever also die one, you'll get whipped out. Okay, so have a good night. Yes, LNG, please hold. Things that never hit the stop loss, things that I did not say anything, please hold. Okay, so don't have to ask every day. I will tell you the same reason. Please hold. If we are gonna cut early, I will definitely mention it. If not, obey the stop loss, leave it as it is. I mean the trade plan is there for a reason lah. The trade, if we are gonna randomly cut here, cut there without no reason, right? Then we might as well don't have a trade plan lah. Okay, so please hold. If your entire account is stuck here, right? Then I will ask you, why is your entire account stuck here? In fact, every single one of your positions should only have 10% of your capital, meaning your account no matter how small your account, you must be able to at least enter 10 position. Okay, my account have 10 position. If your account is like 5K and you are telling me, means my account only 500, my each position only $500, that means your account is undercapitalized. Okay, so all this kind of thing, please take care by yourself. Okay, so double down, please don't double down. Please don't double down. Never ever double down on the rate position. That's the number one. That's one of my other rules that I follow. I sort of give my never double down on a red position. Okay, you can double down on a green position. You have profit to play around. But if you double down on the red position and it gap down or it jump down for some reason, or if I say okay, you need to cut now, the fundamental are not really correct, then because you already double down, right? You might hesitate, you might hang on. And doubling down on rate position is how people die in Alibaba or die in doubling down on SEA. Okay, so doubling down on rate position is your first step to becoming a long-term investor. Don't be that trader. Okay, you only need to make that mistake once. You make that mistake once, it's gone already. Gone already. Okay, so have a good night, guys. We will see each other back again on Friday lah. Or if you have any TP or what, just look out for the Patreon message. Okay, bye bye.